world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Today we explore the wild and wondrous world of equity primary markets. We're joined by Anand Sambasivan, co-founder and CEO of PrimaryBid, Marcus Stuttard, head of UK primary markets for the London Stock Exchange, and Aman Ghei, principal at Finch Capital. To get the conversation started, former investment bankers Anand and Aman walk us through the quirky and questionable dynamics of investment bank-led IPOs and share sales. We then explore alternatives to that model, including direct listings, along with a number of interesting considerations about private versus public market capital raising, risk-taking versus value capture, preference stacks, and more. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Anand Sambasivan, Marcus Stuttard, and Aman Ghei. Anand, Marcus, and Aman, welcome to Rebank.
Thanks for having us.
Good to be here.
Yeah, thanks for joining. I think we have an very interesting conversation teed up tonight. So there's been a lot of talk lately, a lot of analysis lately, a lot of interesting news stories lately around where capital is coming from to fund innovation, whether it's private markets or public markets, how that translates into value in public markets, how that value flows between various stakeholders in the ecosystem, the kind of early stage investors, more mature stage institutional investors, and eventually, hopefully, because in a sense, that's what a lot of it is all about, retail investors who are either directly holding securities or holding them through retirement accounts. And maybe just to kick off for context, we can go around the table and everyone can give a very quick introduction about what they do and what perspective they bring to this. Marcus, do you want to start?
Sure. So I'm Marcus Stuttard. I'm the head of UK primary markets and the head of AIM, our growth market, the London Stock Exchange. So my team and I basically spend all of our time talking to either companies that are admitted to our markets or private companies that are thinking about their next stage of growth and capital raising.
Great. Anand?
Hi, I'm Anand. I'm the CEO and co-founder of PrimaryBid. Ironically, we are a venture-backed company that's focused completely on the public market. So it's sort of sitting in between Aman and Marcus here. But we see certainly value on both sides of the fence, and I'm really looking forward to this conversation.
Cool. I'm Aman. We're an early stage investor here at Finch. I've been on the show a couple of times, so hopefully people know. We've invested in over 40 companies, companies like Zopa, Trussell here in the UK, but also a company in the investing space, a company called Bucks that Anand, you probably know. So do have some
So they made
exposure.
a crypto acquisition recently.
Yeah, they bought a crypto exchange.
Interesting.
Yeah.
All right, so maybe the best place to start, because I think it can provide a foundation for a lot of this discussion, would be Anand and the company that he co-founded and runs. So PrimaryBid, maybe you can talk about the problem that you guys are solving and kind of what it was in your experience that led you to recognize that.
Sure. Look, I'm a banker by training. I started my career on Wall Street and continue to here in London. And one of the things that blew my mind, even coming in as an analyst, was just how public markets worked and how the big institutions were able to capture value that retail couldn't. And particularly telling was when you have a public market that's either anywhere between sort of 15 to 40% owned by retail, depending on where you are, and this segment of the market can't capture the same value. It's well, as a retail investor myself, it was depressing. So I sat as a bank thinking, well, I see these institutions buying follow-on deals at discounts, playing the IPO calendar. I want to do the same. And I came to this very sort of sad realization that I couldn't. So if you can't beat them, join them. So I started a hedge fund a few years later, and I just started doing it, and it was incredibly successful.
Can you just, in a bit more detail, describe exactly what the play was there with the hedge funds? I think it's very relevant.
Sure. It's quite simple, right? So you have publicly listed companies raising capital all the time. They raise something like tune of $5 trillion a year in debt and equity securities. And that's just follow-ons, and they do IPOs too, obviously. And all of these deals are priced at very favorable pricings, anywhere between a few percent to double-digit percent discounts to the share price, depending on the size, the riskiness, the deal profile, that kind of thing. And it's available exclusively to institutional investors. It's not a single share, literally not one share goes to retail or is available to retail. And it's not, something Machiavellian here. It's the fact is, this is a wholesale trade. The system hasn't really changed for very long. It's quite efficient. It provides $5 trillion of capital a year, but there's no need to sort of include a very fragmented base. There never was one. But in today's day and age, with the sort of appification of the world and API technology, you can actually capture a huge segment of the market and allow them to participate in that same value. And that's what we did. So that's what PrimaryBid started. We started a company that actually pushed these deals out to retail investors. It was extremely successful and led to a point where we did a deal with the London Stock Exchange, where we wanted to create the widest net possible and really create that retail infrastructure across the UK for the capital markets.
Yeah. Excellent. So you guys have raised, I think, a significant amount of money to date. You're backed by some interesting investors. Can you talk a bit about that part of it?
Sure. We just raised 7 million sterling. We had three VCs there, primarily led by Pentech and Outward Ventures. And the purpose of this capital was just to accelerate now what we've been doing. We're a fully regulated company. We've got the perfect team in place. We've got incredible partnerships that I could only dream of with the stock exchanges. And as a finance geek, they invited us to open the market, which was like dream come true. And so all of it in place now, and the purpose now is say, okay, well, let's take our traction, our technology, and scale it up, mid caps, large caps. There's no reason we shouldn't be doing the AstraZeneca transaction or Ocado or those sort of things.
Yeah. So the concept is basically that retail user downloads an app and through the app can buy X number of shares of this newest primary or follow-on issue?
Perfect, exactly. And that's one channel. The other channel is what we're doing with APIs, and it's very close to the rollout we're doing with London Stock Exchange and pushing it directly to brokerage accounts. So soon, you'll be able to participate directly through your brokerage account.
And these are UK shares?
Currently, yes.
Yeah. And the goal, I imagine, is to roll out to more global shares and access it on a more than just UK only scale? Yeah,
exactly. This is a problem that exists globally. 37% of US public equities is directly held by retail. France, big. They just did the Française des Jeux IPO. They got something like 1.3 billion euros of retail from 500,000 retail investors, but they don't know how to do it on follow-ons yet. So we've done a similar transaction or agreement with Euronext, and that allows us to scale across 9 geographies in continental Europe. So it's a problem that exists across the spectrum. I mean, I'm a huge fan of the public markets, and I think the primary segment of the public markets just needs an update, an upgrade, and that's what we're here to do.
Yeah.
It's interesting, like the media is so fixated about the first day pop. Every time a company goes public, everyone's talking about, it popped 5%, 10%, or it fell. And it's, to Anand's point, there was a stigma, I don't know, rightly or wrongly, that we want a Fidelity or a T. Rowe to back our stock because they're long-term investors. They won't sell. They believe in the story. That's not necessarily true. And PrimaryBid, a company like Anand's, is kind of opening that to retail investors to feel part of, hey, I want to be part of Uber. I'm a user and I understand that business. So it's a really interesting phenomenon.
All right. So question for you, Aman. You also have an investment banking background. The pop that you referred to, is that intended to incentivize institutional investors to participate in the deal? Is it intended to compensate bankers for their work in getting the deal out the door? something else?
Personally, for me, it's a bit of everything. The people who are probably the worst of the situation is the company itself, because they've left all this money on the table.
Because the pop is, it's pricing the IPO at less than
At
the
a 20
fair market
whatever,
supply and demand based value of the stock.
20% discount. So when it pops, it feels like, I think a lot of it is sentimental driven. Obviously, there's some economics that go with it. We were talking a little bit about the greenshoe option and a couple of other things in the US that help make up for margins on IPOs declining. So there's some fundamentals that go to it. But at the end of the day, if a stock pops 20%, theoretically speaking, you've not priced it correctly. And the company's worse off because they've left 20% of that money on the table that they could have raised if they're raising money in a primary.
Although the flip side to that, and I always hear both sides of this argument, is it is a systematic underpricing. That's a fact, and it happens, and there is a pop. But this is what allows BlackRock and Fidelity to actually come and look at your $1-2 billion IPO. I mean, these guys typically aren't going to come to a smaller, riskier transaction, and the private to public transition has been happening forever, and it's been happening this way, and it's sort of working because the pop exists and it allows these big public market investors to come in and participate in the deal. Yeah. So you are right. I mean, the company is worse off. The selling shareholder is worse off. Yeah. But without the pop, who knows if the deal's even on the table.
Yeah.
Yeah, well, I think that there's a big cultural element here. I think typically in Europe we don't see the same kind of culture around that first day pop. I think also we see typically companies that float on markets like the US markets initially offer a much smaller proportion of their shares to the market, and so that restriction of supply then kind of creates that short-term aftermarket demand.
It's like the Saudi Aramco, right? Microscopically small number of shares.
Yeah, but by value, clearly, given the size of the business, it was a large transaction. But we see this in much smaller companies where that supply of shares initially is reduced. So there tends to be a lot of media coverage, a lot of hype around the IPO. But what we're really interested in as a market operator is actually the long-term valuation, the long-term performance of a business, and the long-term valuation and access to capital. And so, a big part of what we're trying to do with PrimaryBid in particular is to make sure there's a really good mixture of shareholders on a shareholder register, because for any market you need buyers and sellers all the time, and you need people who've got different time horizons, different holding strategies. And so from the outset, if a company has got retail investors and long-term institutional holders, you can generate a situation hopefully where not only have you got lots of daily trading and liquidity, but you've got the long-term provision of capital. So, if we look at 2019, for example, there was £30 billion just raised through equity transactions. About 7.2 of that was through IPOs. The other 23 billion was by companies on the market doing follow-on capital raising. So, we're really interested in institutions providing long-term capital and retail also being able to participate, but also form a very active part of the trading and the liquidity.
Yeah. What are the implications from the company's perspective, and the issuing company's perspective, of having, say, a 100% institutional shareholder base versus in the extreme 50% retail, 50% institutional? Does that expose them to, greater risks during market downturns, or does it help shore them up? I don't know.
Well, no. I mean, look, I think that you want to have a healthy balance between institutional and retail. I mean, either side, 100% retail, 100% institutional, is not healthy, particularly because you want to have a distributed shareholder base. That is one of the sort of fundamental tenets of being public. You want to be liquid. You want to trade. You want to have it, by virtue of being public, anyone is allowed to go and buy your shares in the market. And I hear anywhere between 10 to sort of 30% of your cap table in a post-public world, you want it to be in retail hands, and that creates a healthy level of price discovery, liquidity, and so on in the stock.
Well, and also, increasingly the institutional investors or retail, even if they intend to be long-term holders of a stock, they want to know that if they need to be able to exit that holding, they can do, and liquidity is the key to that. So, even if you are intending to invest for the long term, you will look at a company, you will either look at the size of it, the amount of likely liquidity, when you make the decision about the price at which you want to invest. So, we all know there is a liquidity discount if you expect a company, either because it's very small, it's got a low free float, or it's all held by founders and management. You would expect them to have to offer a greater discount in order to get either an IPO or a further capital raising away. So that whole aftermarket liquidity comes to the core of the cost of capital for the issuer.
Is there I think Anand mentioned, kind of like a 2-3% to up to 10+% discount for these follow-on issuances because in some cases of an associated risk element. So I think Metro Bank, publicly listed company here in the UK, was looking to raise capital recently, and there was a substantial risk associated with that. I think they initially tried to issue maybe as a convertible debt instrument or something, which didn't get out the first time around, and I think they managed to do it on attempt number 2. Are there consumer protection concerns in direct issuance to retail investors? Is that something that you guys think about?
We're talking about specifically with PrimaryBid, public equities. We're talking about a stock that anyone can open up a stockbroking account and buy it. I mean, it's called public equity. So by its very name, it's available to be purchased by the public. It has gone through a very rigorous process of listing on the stock exchange. It's got the right level of governance, and technically, legally, it's deemed as what's called readily realizable securities. So when you have these level of liquidity, you have an aftermarket, you have governance standards, you have transparency rules. It's crucial, right? I mean, if I'm a private company and I lose a license, there's no rule that I have to disclose this around. The public company, if you do it and you don't disclose it, you probably could go to jail, right? So it's market abuse regulations. The governance standards are so big that there's an inherent filter for listed companies. So from our perspective, when we do a deal, we're offering that same security just at the price that the institutions, the big guys, are buying it at. We're just offering that same price, effectively Costco for public equities.
Yeah. What's interesting is there's this misconception that if you do direct listing, you don't have to go through all the same reporting, legal, compliance requirements. That's completely not true. You got to do exactly the same thing. So take a Slack or a Spotify and talk to their CFOs. They probably did exactly the same thing that they would if they were actually issuing equity, i.e. taking in capital.
So you do all the work, but you don't get any money.
Yeah.
Well, that's also a kind of interesting concept. Like, if you think about how the process used to work not so long ago, you did your seed round, your Series A, your Series B, Series C, you raise money in an IPO, and that's life. And if you look at it now, I mean, you have rounds going to D, E, F, and these rounds are being purchased by the BlackRocks and the Fidelities, and guess what? They're getting the pop on those rounds. So the pop's already happening. It's just happening on the private side, and then they just directly list, and it's almost a technicality. It's a direct listing is my shares couldn't be traded today, and tomorrow they can be traded.
And presumably there are very expensive suit-wearing capital introducers and advisors involved in Series E, F, G, H rounds also, right? I mean, what's the difference between the model that Anand you just described, where companies stay private for longer, selling these same institutional investors, and the traditional IPO in lieu of Series D or whatever it is?
Yeah, so I think to Anand's point, it's a function of where the money has gone, right? So there's, quote unquote, there's been a shift towards private capital markets. So funds, venture funds, private equity funds, long-term asset managers have just raised record sums of money. And at the end of the day, they need to deploy it, right? And if companies aren't going public in the traditional way, they need to find an alternative way to deploy it. And by coming in at, as you say, Series D, Series E, Series F, they're still deploying the capital. If you think about the companies they're deploying it in, fundamentally, not a lot has changed. These are still kind of companies on the verge of being market leaders. Okay, you could question their ability to have sound profit economics, and all those kind of things. I think there's a kind of judgment element over there. But back in 2000, there was also a judgment element, and people were pricing off of unique users, right? So I just think it's a fundamental shift in where the capital has been allocated. And because it's in private markets, the BlackRocks of the world, the Fidelities of the world, have just become supremely active at writing 250 million checks in private companies. And instead of taking a 10%, 15% pop at IPO, what they say is, hey, let us ride 2-3 years, and actually our effective IRR when you direct list or if you go IPO will be much higher. So our returns will be much greater.
So playing devil's advocate, is this trend of traditionally public market investors investing in late stages in the private market, one, like, cover for market manipulation? Like, are they getting preferential terms? Are there backdoor deals getting done that aren't reported? Doesn't have the same level of governance, same level of publicly available due diligence? And secondly, and I'm not saying it is or isn't, interested in your guys' view, is there value that's being transferred from the kind of more traditional earlier stage venture funds of the world to these more institutional, traditionally public market investors that retail investors aren't participating in that they historically may have?
Yes, on the first point, protection is interesting, and not a lot of people talk about this, but when you're private, you start building up what you call a preference stack, which means the last money in is the first money out. So if BlackRock puts in $250 million in a company goes, okay, it doesn't go belly up tomorrow, but if it sells for $300 million, guess what? BlackRock's on top of that preference stack. They get their $250 million back first, and then the rest have to fight over the 50. If they were buying common, that's a completely different story. So there's a risk-reward component there as well to think about. Your second question, yeah, look, I think kind of there've been some folks that have been trying to get into the secondaries market. I can't remember the company in the U.S. what it was called. They did employee secondary offerings. So a lot of employees get options. They'd like to liquidate, get some
second market.
Second market. That's right. And so there are some of these avenues that just haven't found their right scale on the retail side. Yeah.
Look, I think as a public market investor, what I can tell you is the public market is brutal. And what I mean by that is you virtually always with liquidity have consensus opinion. Something is if you get your price wrong, you're going to get beaten on the other side. You're going to lose money right away. So the financial discipline is massive. And then I look at private companies with these super funds where you don't have consensus opinion. I mean, WeWork was just valued at $48 billion because SoftBank said so. One investor said so, and they had the capital. But it comes to the public market when it's brutal and it has consensus opinion. Guess what? That valuation no longer counts. So the fear I have with companies staying private longer is when they list, there's nothing fundamentally different about the company, but the valuation could shift dramatically, which people lose faith in the company and the valuation and so on. The public markets are crucial for this, and in my view, companies need to come back and start listing earlier than where they are now.
Yeah, I think we're sort of tending to focus on some of the highest profile, the larger transactions. I mean, let's not forget that actually there continues to be a very close and sort of symbiotic relationship between the public markets and private markets. So, if I just look at London, for example, I know that since 2014, about 48% of all of the capital raised at IPO has been through sponsor-backed, whether that's VC, private equity-backed businesses. So, private equity are big users of the markets, and it is a two-way relationship. The public markets still provide a very valuable baseline valuation metric. Public companies are often the trade buyers of private businesses. private equity buy companies off the public markets, but also, float companies. So there is, and there continues to be, a very two-way relationship. So I think, we shouldn't just kind of view this as a one-way street. Mm-hmm. And also, in my role as head of AIM, I focus a lot on smaller companies, and we're seeing, parallel trends happening in smaller companies, in that, we're seeing businesses that have either been crowdfunded at an early stage, or they've had the backing of business angels or syndicates of business angels, where they aren't necessarily being passed on through that sort of traditional funding ladder onto venture capital or private equity, and they want to come straight to the public markets because some of those early stage retail or angel investors don't want to get diluted in a C or a D round. So, I think the key here is that we provide founder investors and companies with the widest range of choice. And actually, one of the things that we should be absolutely celebrating is that it wasn't that many years ago that for high growth private businesses, their number one barrier was access to capital. And it's not anymore. The companies have a much wider range of choice of both private and public funding rounds. So let's not kind of overly beat ourselves up about some of these things.
Marcus, curious, do you see the public side changing from a regulation / cost perspective? I feel like when I talk to a lot of CEOs, CFOs, at the back of my mind, that's probably their kind of number one concern is, oh my goodness, I'm going to have to hire tons of people to put up with the regulation
/ grow up.
Yeah, exactly.
So, I'm very conscious of trying to make sure there is, as much of a level playing field between being private and public as possible, and so that there isn't, a kind of cliff edge when you get to that transition from private to public. And clearly there is more disclosure, and to Anand's earlier point, it's a lot more transparent on the public markets than in private markets. But, actually, let's look at that the other way around. The number of times companies, and particularly, relatively small and high growth businesses, have turned around to me over the years and said, do you know what? We've actually been able to win contracts once we floated that we just couldn't as a private business, because, that having gone through the preparation for IPO gives a lot of credibility to businesses. So they can not only win investors from the widest pool possible, whether that's individuals or the BlackRocks, Fidelities, the big institutions that we talked about earlier, but also their credibility and their visibility increases immeasurably. So it can really help the business. The other thing is we are seeing an increased focus on corporate governance in the wider sense. And I think we're seeing that in private markets as well as public markets. So we're seeing a lot of sort of parallel trends. But I think also to one of the points we discussed earlier, the wider investing public are getting fed up that they can't access these high growth businesses on the same terms as the institutions. So there is a much greater societal focus on an equal distribution of wealth. Floating a business and enabling not just founders and management team and employees to access that growth potential, but the wider investing public is really what the wider society are calling out for.
Mm-hmm. We talked a bit earlier about some of the, call them idiosyncrasies, I guess, to be nice around the whole involvement of investment banks and helping companies get to market, and some of the places where maybe that leaves value on the table. And we saw Spotify, I think it was last year, effectively opt for a direct listing, which to me, and I'd be interested in your guys' opinion, felt as much like a kind of philosophical rejection of that model as anything else. So, despite the fact they didn't raise any money through that, presumably they didn't need any money at the time, and indeed, I guess if they had needed money, they probably could have raised it privately just as well as publicly. But I think there are some important reasons why high growth companies, especially venture-backed companies, might want their shares publicly traded, which have to do with stock options, early investors, employment incentivization. Aman, do you have any thoughts on that?
Theoretically, you're right? I think kind of it makes a lot of sense to go public. You're doing all the right things, governance in place, procedures in place. It just comes back to there's just so much capital available in the private markets that it just gets tempting for investors, the CEO, employees to maybe take the easy route, right? And I think
less employees though, right? Because they're kind of like locked into these
you say that. I mean,
stock units and stuff.
The venture industry is also innovating. I have a lot of friends that have started companies that focus on providing employees of privately backed companies liquidity. So
lending against their shares.
They would go to the employee and say, "Hey, you have X vested options. Let us buy it off you as a fund on a fund level," and you do that. We have different schemes. There's a fund that does this for EIS-backed instruments as well. So I think people are getting kind of innovative around the types of offerings. I think if you're a consumer company, that changes things a little bit. Spotify is probably the most well-recognized brand, definitely in Europe. And I think for them to be public was definitely a little bit of a statement. And it's interesting because I think if you look at Spotify's numbers, they're actually in need of money, right? Like they're not a profitable business. But maybe at that time they didn't need money. And so for them, it was a little bit of a statement to show maybe the record labels that and the artists that are fairly public about Spotify that, hey, we're really a force to be reckoned with. So it's a little bit of a kind of, I would say, a mixed bag when it comes to that. I would say from an investor standpoint, the best thing about direct listings is generally the lack of a lockup period, right? Which is crucial, right? So typically, if you're going public and you're issuing equity, you're locked up for 12 months. Correct me if I'm wrong.
The founders or the pre-IPO shareholders?
Pre-IPO shareholders. If I'm an investor before the IPO, I'm locked up before I sell my shares. With a direct listing, that's not the case. So it does provide instant liquidity for a lot of folks. So there are pros and cons. And I think kind of if you're a consumer company, it's probably a little bit of an easier kind of path to recognize the direct listing component. But yeah.
And there are flip sides to all of these things, aren't there? So I think it is very company specific because you made a very good point about you don't have the lockup, but for some companies that might cause them a fear that they're going to get volatility as founder shareholders sell out shortly after the introduction to the market. Similarly, you made a comment about for some management teams they feel that like being private is the easy option. But equally, there are plenty of founders and management teams of private businesses that will say actually they would prefer to be public because they kind of feel like they've got more control over the day-to-day running of the business where they've got a wide shareholder register rather than maybe one or two strategic investors who can call all the shots and can hire and fire on a day's notice. So I think it is very company specific.
Look, ultimately, even if you take this to the nth degree, and companies just stay private, get bigger and bigger and bigger. At some point, there's nothing, at some stage you can sell your company and then you become too big to be bought. And then the only way out is an IPO. And
are you talking about digital bank valuations?
You got to return money at some stage. Yeah. So everyone's got to return money at some stage.
Exactly. So, it's the public markets are always going to be there. And it's just a question, I guess, of when you list, how you list.
I think the one thing we haven't talked about, which I think is really important for a public company, is the currency that it has, right? A market-approved, as you were saying before, not a one-person-approved pricing currency to go out and be aggressive. Back in kind of when stock prices were high, obviously it's a little bit correlated to the market and where the indexes are, but 2004, 2005, 2006, some of the highest percentage of share purchases in M&A deals, right? Because people have the ability to use their stock as currency. Doesn't happen that much in the private market, and primarily because I think the people who are selling always have that question: hey, is WeWork really worth $40 billion just because SoftBank paid $40 billion for it? I'm not selling my company for WeWork share at $40 billion. So that's where I think you really need public market validation for M&A.
Great point.
Yeah, both if you're using those shares as a public currency for acquisitions, but also, this isn't sort of binary. It's either private equity or the public markets. One of the other big benefits, I think, for a lot of companies of being public is that quite often the banks and other lenders will provide debt facilities, for example, on better terms where they know that company's got recourse to a much wider set of investors. So, I think there are lots of factors that companies need to take into account when they're thinking about their options.
Excellent. This was a fascinating conversation. Thank you all very much for your time. Marcus, Anand, and Aman, thank you very much for joining us today.
Thanks for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.